Wanted to do something a little bit different here. We're kind of at this point in this class where you have a lot of practice problems, and I definitely want you guys to see me working through these problems. You know, that's the kind of thing that works really well in a traditional classroom, and for these online classes, it's not so great. So I'm just going to go through basically this entire worksheet and explain some of my answers. And I don't want you guys to think that this is all just review or just an explanation of answers. There's new material kind of built into these answers. We haven't solved questions like this yet. And so I'm hoping by going through this and explaining it, you can understand how to solve. And it's definitely going to help you on the quiz and the test. The questions that are in here mathematically are really similar to the ones you see on the quiz. So I'm just going to go through this entire worksheet. Question number 1 here, explain the difference between traditional and Roth investments. Remember that traditional investments, you pay taxes on it in the future. So if you contribute $1,000 to a traditional 401k, you will not pay taxes on that now. But when you withdraw from those funds, you'll pay taxes on the full amount then. So if in 40 years you decide to withdraw from the account and now there's 30 grand in it, you'll be taxed fully as income on that $30,000. Conversely, Roth accounts, you pay taxes on them now. So if you contribute $1,000 to a Roth 401k, effectively that money is going to be taxed before it enters the Roth account. Question number 2, you expect tax rates to change very little. You expect your income to increase over time. So if your income is going to go up over time, you want to pay taxes on it now rather than the future. So generally there, a Roth account would be better. Specifically Roth 401k, because that's what we're talking about now, but any kind of Roth account is better when you expect your income to go up. Question 3, if you expect it to go down, well then traditional is better because you want to pay taxes in the future when your income is lower. Question 4, you expect tax rates to greatly increase over time. If tax rates are going to go up, you do not want to be taxed in the future. So you'd prefer a Roth account there. With a Roth account, you will be paying taxes on it now and not paying it in the future. And some people have used that logic to justify Roth accounts. That basically, you know, the U.S. government is tremendously in debt, and so you can make the argument that they're eventually going to have to raise taxes, so maybe Roth investing makes more sense in that regard. No way to know for sure. You expect tax rates to greatly go down over time. You would want to go traditional. It's the exact opposite logic. Right now there's no way to predict taxes, but maybe in the future they announce they will raise taxes in a few years. Well, if you know that's coming, then you might want to switch over to a Roth account. Question 6, charge into my HR department with a $100 bill and state I would like to make a $100 traditional 401k contribution. Can I do that? The answer is usually no, almost always no. 401k accounts are tied directly to your income. So if you want to make a 401k account, basically $100 of your income is going to need to go to the 401k before it hits your bank account. So if you just go to your HR with a $100 bill, that money is not connected to your income, so that is not going to work. 401k accounts have to be connected to your income. Let's see here. Question 7, does a contribution to a traditional 401k reduce my Social Security tax rate? No. 401k accounts basically happen after you've already paid Social Security and Medicare taxes. So if you contribute $1,000 to a traditional 401k account, that $1,000 has already been used to pay Social Security and Medicare taxes. It's a little bit confusing, but basically when the HR department moves your money into your 401k account, they've already basically applied your Medicare and Social Security taxes to it. So if you put $1,000 into your traditional 401k, there will be a full $1,000 in your traditional 401k, but just know you still paid Social Security and Medicare taxes to the full extent. 401k accounts, whether traditional or Roth, do not do anything to reduce your Social Security or Medicare taxes. Let's see, I make $10,000 in Roth 401k contributions this year. In 35 years, I withdraw the funds. What taxes will I pay? No taxes at all, because 401ks have already fully been taxed. I make $10,000 in traditional 401k contributions this year. In 35 years, I withdraw the funds. I will pay income taxes only, both federal and state, if we're in a state like Georgia that has a state income taxes. You're not going to pay any Social Security or Medicare taxes on that. Social Security and Medicare taxes are attached to your actual working income. So if you're just receiving from a 401k in the future, you're not going to pay taxes on that because remember, you already paid your full Social Security and Medicare taxes when you were working. The 401k does not avoid those types of taxes. All right, so this is questions that are very similar to the ones on the quiz where I'm just going to go through the assumption just to make sure you get these. So you're married, so we're going to be using these accounts up here, or these tax rates. The current year is 2022, and you just graduated from college. You earn an income of $90,000, and then let's assume in 2052 you'll have an income of $1 million. So you can already tell that big income disparity. If you're going to be making contributions, you would prefer to go Roth to pay taxes now in 2022 and not in 2052. Assume your income tax rates posted above apply to married individuals like you, and that the tax system doesn't change over time. That way we can solve for tax rates in the future if we need to. For simplicity, let's assume you live in Florida. You're welcome. Let's not deal with Georgia state taxes. Florida doesn't have state income taxes. That'll make these questions easier. Finally, assume that the U.S. stock market earns an average nominal return of 10% per year compounded annually. And let's just assume there's no expense ratio and you earn the full 10%. On the quiz, I gave you a question with an expense ratio. Remember, if there's for example, if there's a 1% expense ratio, then that would just turn this into a 9% interest rate. So that's easy enough to make that change if you need to. All right, so let's go through these here. In 2020, you make no 401k contributions. Solve for the following. Your income tax is paid in 2020 and so forth. So this is the exact same style of question that we've been seeing in the past year. Your taxes are going to be based on $90,000. You can go through and just solve for $90,000 worth of income taxes the same way we've been doing in the past. And you should get a federal income tax burden of $11,380. Make sure you get that answer. Social Security, you're going to pay 6.2% of this full amount. That's your answer. Medicare, 1.45% of this full amount. There's your answer. And so your net income is $71,735 and your effective tax rate is 20.29%. None of that is new. That's all stuff that we've been doing in the past. All right. So now let's change it up here a little bit. And let's think about now if you make $12,500 in traditional 401k contributions. Okay. Now, when you make $12,500 in traditional 401k contributions, your income will be driven down to $77,500. All right. In terms of your income taxes, your income will be driven down by that $12,500. And this is a little weird because notice you're making $90,000 originally, which puts you at that 22% tax rate. Now, when you drive your income down, you drive it down to the 12% tax rate. This is a really important point to make. Driving down your income, your taxable income, is really important, especially when you have these income jumps. Okay, let me give you an example. Let's say you made $81,000. Well, if you make $81,000, $750 would be taxed at 22%. So you might decide to contribute at least $750 to your 401k so that you don't ever pay any 22% income taxes. This is where you can be very strategic with your planning. And so it looks like this person maybe is thinking about that. They made $90,000. But if they make $12,500 in 401k contributions, that will drive them fully out of the 22% tax bracket, which is very nice because paying 12% is not so bad. All right, so now their income taxes will be taxed at $77,500, and that's what you should get for their federal income taxes, okay? That's the only thing that changes, you'll notice, because the $90,000 still applies to Social Security and Medicare. Social Security and Medicare are based on how much you're earning from your work. And your 401k is irrelevant in determining those values. So you're still going to pay the same amount there, all right? But you should find that they have about a 17.5% effective tax rate now that they're making their 401k contributions. So they're able to essentially drive their effective tax rate down from 20.3 to about 17.5%. All right, so now let's think about a Roth 401k contribution, okay? So this Roth 401k contribution doesn't do anything to your taxes because remember, if you make $12,500 in Roth 401k contributions, that means you're paying taxes on it now. So this is exactly the same answer as what you get in question 12, where you're trying to estimate their taxes with no 401k contributions. That doesn't mean it's valueless. It's still really nice to do this, because if you do the Roth 401k contribution, as I've stated here, this will lead to no taxes in the future on this money. So once you've put money into your Roth 401k account, yeah, you're taxed on that as income, but it's never taxed again. So if this $12,500 that you put in grows to $600,000 when you retire, well, that $600,000, you can pull any of that out and not face any tax consequences, which is really nice. Okay, so now let's put in some investments now. Question 15. In 2020, you make $5,000 in traditional 401k contributions and never make any more contributions. How much will you have in this account in 30 years? Simple math, all right? The $5,000 will not be taxed now. So you're going to earn 10% interest based on the assumptions we had at the top of the sheet. That leads to about $87,000 in total value in the future. A tougher question here. How much taxes will you pay when you withdraw it? Well, remember, back in the initial assumption, we assumed you were making $1 million a year. So if you're making $1 million a year, that means your income tax bracket is clearly in the 37% group. So if you add any more income to this, you're going to be taxed at a 37% rate. Okay? So going back to this question here, this $87,000 you have will be taxed at a 37% rate. Okay? Whoops. Let me make this adjustment right here. It's kind of an artifact of an old question there. There we go. Okay, so this is the correct answer here, the $32,000. So that $87,000 will be taxed at a 37% rate. So that's how much your taxes would be, and that would leave you with this much money, okay? Again, the logic here is the $5,000 that you put in is not taxed at all when you first put it in, because it's a traditional 401k, so it grows. But when you withdraw the money, you're then fully taxed on it, okay? And this is where, if you have a traditional account, you want to be really strategic. You don't want to make a huge withdrawal from a traditional account, because then it'll fully be taxed at that point in time. So you might want to kind of trickle the money out so that you avoid the high tax brackets. Okay, now starting over. You decide to make Roth 401k contributions. And this question's a little funky the way it's written, but there's no easy way to write it. So this is me doing the best I can. In 2020, you decide to take $5,000. All right, I'm choosing $5,000 so we can compare to the answer from question 16. You decide to take $5,000, pay income taxes on it, and then contribute this money to a Roth 401k. So this is like, basically, let's say you have $5,000 you want to save, you could go traditional or you could go Roth. But if you take that $5,000 and go Roth, it first has to be taxed as income before it enters the investment phase, okay? So the $5,000 is going to be taxed at the 22% tax rate. The reason being is that if you earn $90,000 here, if you're earning $90,000, you're at the 22% rate. So if you take $90,000, pay taxes on it, take the $5,000 out of that amount and pay taxes on it, all of that money is effectively taxed at the 22% rate. Anytime you're doing this type of calculation, pull from the top. What I mean by that is, out of the $90,000, you should think about your income from being at the top. The reason is, if you take $5,000 and put it into a traditional account, you avoid a 22% tax rate. So if you want to put $5,000 into a Roth IRA account, you need to think about how you are not avoiding a 22% tax bracket. We're trying to compare apples to apples here. So that 22% tax bracket is what's relevant in this question. Let me say that again, just to make this clear. If you put $5,000 into a traditional 401k account, you are avoiding a 22% tax bracket, okay? Because you go from having $90,000 in taxable income to $85,000, so you're avoiding 22% tax bracket. So when you think about making a Roth 401k contribution, you should use the 22% taxes, because that's comparative to what you're not getting because you're choosing Roth instead of traditional. I hope that makes sense. So going back to this question here, with a Roth account, that $5,000 is taxed at 22% before it enters the account. So I'm taking $5,000 in gross income, paying income taxes on it, which leaves me with $3,900. I don't need to worry about Social Security or Medicare taxes or anything, because I'm paying that regardless. regardless of whether I'm going traditional or Roth, I'm still paying that amount. So it doesn't matter in regards to this question. But if I go Roth, I got to pay taxes on this money now, which is different from a traditional account. So $3,900 would be entered into my Roth 401k. It would grow at a 10% interest rate for 30 years, leaving me with that amount of money in my account. Notice with the Roth account, you're left with less money in your account than you would with a traditional account. With the Roth account, $5,000 of gross income turns into $68,000 in 30 years. With a traditional account, right here, $5,000 in gross income turns into $87,000. But this traditional account has not been taxed yet. The Roth already has. So it turns out, based on this person's income being so high, they won't have to pay any money in the future, which causes the Roth 401k to have much more buying power in the future than their traditional 401k. Again, the reason is the traditional account here, they have to pay a 37% tax rate when they withdraw the money in the future with the traditional account. But with the Roth account, they don't have to be taxed at all. So even though there was less in the account when they withdrew it, since they didn't have to pay any taxes on it, the Roth account was far superior. And notice it's not a slight difference, it's a big difference in terms of how much money they have in the future. And that's what I mean when I talk about how this class can make you wealthier, right? If you can use proper tax planning and make the correct choices on Roth versus traditional, that could be a 50,000 choice for you right there. That's why I love teaching this class, because I think there's a lot to learn and a lot to use. So based on your answers from the questions above here, I think the numbers may have gotten out of order, my apologies, but based on your answers above, the Roth is better because your income is so high in the future. And as the final question here, kind of a non sequitur of sorts, how are dividends handled within a stock index fund that is contained in your 401k? Dividends are reinvested into the account. So if you have Apple stock, for example, and Apple pays dividends, you'll notice just cash enters your account. So, $3 shows up in your account and it's not invested in anything. It's just cash paid to you. But in regards to these funds, index funds and mutual funds, they are set up to automatically reinvest dividends. So if you have $10 in dividends paid to you, the account will automatically buy back more of itself. So if you've got $1,000 in a S&P 500 index fund and earn dividends, the dividends will be reinvested back into the account. That's really important to recognize, because what that means is you don't have to worry about logging into your account and figuring out what to do with dividends. The dividends will automatically be put back into the investment. Okay, I hope that helped. Feel free to give me feedback if you have any questions. If you think this was really helpful, let me know. If you think it was not so helpful, let me know so I can stop wasting my time doing these videos. But ultimately, I want to try to arm you guys with the knowledge you need to do well on the quizzes and exams without spoon feeding you. And so I'm hoping these types of videos will help. Again, let me know if there's anything I can do to steer you in the right direction.